Hello dear community and very welcome to our live stream today. We are at AVCO Jahrestagung 2018. AVCO is the Austrian Private Equity and Venture Capital Organization, and we have a lot of experts here today talking about the capital markets, talking about investing in innovation and digitalization. And we have a very distinguished guest with us here from Denmark, from Copenhagen, Rolf Kjærgaard. Rolf, welcome to our interview.
Thank you so much. Happy to be here.
We're going to be talking about fund-of-fund concepts in venture capital and private equity. The issue that we're dealing here is that we're missing Series A, Series B capital rounds in Austria, for example. We're very good in financing seed phases of startups, but are lacking, let's say, the serious money, the biggest volumes, bigger volumes in the later stage. Denmark implemented, I think, a very good model that we mentioned in Austria very, very often, that also AVCO is taking as a role model for them. And I'm very grateful to you that you're going to be explaining about this model, about experiences with it. But let's start maybe with a question, why? What problem did you tackle? What problem did you address with this concept?
Back when we set up this fund-of-fund model in 2011, Denmark was coming out of the financial crisis, as were multiple countries around the world. We'd just gone through some pretty tough years, and there was a lot of risk aversion out there. And still we had that growing community of startups and venture capital investors looking to raise funds so that they could keep investing in the startups and help build and scale those companies. But when we looked across the local ecosystem, when we looked across the Danish VC market, it was pretty clear that capital had dried out. Not 100%, but it was really tough raising funds for new VC entities back in the day. And the reason for that was partly the financial crisis and that the prevalence of risk aversion, partly some really bad experiences with investing from Danish pension funds in local VCs a decade earlier. There had been a lot of money flowing into Danish VCs.
In the dot-com bubble?
Before that, during, and in the years following that. Most of these investors had not returned the capital that they had been entrusted with. So of course pension funds were discouraged by those experiences, and because of that, reluctant to invest in new endeavors and new funds, even though the remaining VC players were the ones that stood it out, went through all that hardship, and had learned their lessons, definitely. So what we decided to do was try to tap into all that pension fund money. There's no lack of capital when it comes down to it. If you look at the Danish pension fund system, there's the total assets under management is twice the size of Denmark's GDP.
Whoa.
So a lot of money out there. The difficulty is mobilizing some of that capital to be invested in local VCs, to be invested further on into local startups. What we did, driven by a very strong political message sent by the Danish Prime Minister to set up a fund to help resolve this issue and solve this problem, was to sit down with Danish pension funds and work out a model whereby they could provide funding to be channeled through a fund-of-fund mechanism to be managed by Vækstfonden, our organization, and then distributed across a series of VC funds and private equity funds to allow for dissemination, allow for risk distribution throughout the portfolio.
And the main goal behind it was to enable financing innovation and young entrepreneurship.
That was the main goal because of that shortage of capital available for VC fundraising and also some of the small cap, mid cap buyout funds. So when we sat down and designed the investment strategy for this entity, our fund-of-fund model, we included both VC exposure and small cap, mid cap buyout or private equity exposure, and set out to put together a an overall portfolio to consist of 20% VC, 80% private equity, small cap, mid cap buyout funds, even mezzanine funds if there were some of those around. And coming back to the risk aversion that was still prevalent in the Danish pension funds and multiple institutional investors throughout, the way we tried to de-risk that overall exposure for them was to have them put up 1/4, so 25% of their total funding as equity to be invested in our fund of fund, and 3/4 of that, so the majority of that, to be provided as a loan to Vækstfonden.
Okay.
Which we have then invested in the fund of fund that we manage ourselves.
These are now a couple of topics which are, I think, important when we're trying to understand the structure. We manage ourselves. What does it mean? Is it a private-public partnership? Is it solely private, so to say, fund? How did you set it up?
It's a public-private partnership and a novel one, definitely from an international point of view and from a Danish point of view. Such a thing had never been created before. There was some hesitation, but also some eagerness to design something to deliver on that promise to the Danish Prime Minister, to the political system, that this had to be resolved in a manner whereby everyone involved, including the pension funds, could be accommodated. And building on Vækstfonden's historical experience and performance of being a fund investor. We have been investing as a fund of fund for 15 years prior to that. We had the capacity, we had the platform, we had the network and the experience to act as a GP, as a managing entity for this fund of fund structure.
Okay.
So Vækstfonden is a GP as well as the largest LP of the fund of fund. But
what do these abbreviations mean for our audience who might not be familiar with that?
Sure. When you set up an investment fund, you have the GP acting as a manager, so the one actually managing the money, deploying capital, and making sure it returns properly. And the LPs are the limited partners, so they're investors putting up the money to be then managed and invested by the general partner, the GP. So Vækstfonden is both a GP managing the funds within the fund of fund, and an LP, given that we have borrowed money from the pension funds, which we have then injected as equity, as an LP, as a limited partner of the fund of fund. But around 50 Danish pension funds in total all participated on both the equity and the debt side. So they're also LPs. They're also
LPs. So the investors, so to say, in the fund are the pension, so to say, is the pension, how do you call it, pension funds? Pension funds and private venture capital funds as well.
There are two layers to this structure. As a fund of fund, what we did was we took in money from the pension funds as investors, along with the debt-financed capital that we put up ourselves, the 75%. This money is then managed in the fund of fund structure to be deployed and invested with underlying portfolio funds. So we have invested with 6 venture capital funds and 10 small cap, mid cap buyout funds. So a total of 16 funds in our fund portfolio. Now these funds have then gone out and invested with startups as well as established companies.
That's why you call it fund of funds, because the fund doesn't invest directly into companies and startups, but you invest in venture capital funds who invest then in portfolio companies.
Exactly, you're absolutely right. And the rationale behind this, behind deciding on that structure, was that we did have those fund managers in the local ecosystem who did have experience, who did have the capacity to make investments, only they didn't have the capital to do so. By creating this fund of fund structure, we enabled funding to be provided to these funds and fund managers. And alongside with that, there were pension funds and private individuals, endowment funds also investing with these funds. But our fund-of-fund investment activity and the fact that we stepped in and acted as a cornerstone in these venture capital funds catalyzed money flowing in from other sources.
But you gathered money as the fund of funds only from the pension funds?
That's right.
Okay. Now you mentioned 1/4 of this money that you gather from the pension funds was granted as equity investment, and 2 or 3/4 as debt, as loan. What kind of, so to say, background or what kind of reasoning has this structure? You mentioned that the risiko is minimized. Why? How does it work? Why is it more attractive for pension funds to invest in such a structure?
It was a balancing act. They needed to have skin in the game, so there had to be an equity participation, but also they had that reluctance, or at least a majority of them had that reluctance to taking an all-equity risk in such a new structure, which is how we came up with the breakdown of 25 and 75%. And the de-risking works in the following way, that by providing a loan to Vækstfonden, a state-owned investment organization, they essentially assume a sovereign risk, so a low risk on the overall performance and capital base of Vækstfonden, which is backed by the Danish government. That's on the debt side. Mm-hmm. On the equity side, it's an all-out participation in the upsides as well as the downsides.
But the 3/4 of the debt side investment balanced that risk out.
That was the way we structured it back then in the Danish Growth Capital 1, which is what the entity is called. A few years later, in 2015, we finished investing out of that, that was when the investment period terminated, actually in 2016. But prior to that, we had started raising a new fund of fund. And in that model, building on some pretty promising results so far with the investments we had made, we were able to put in 2 options for investors to choose from. One was still a shared debt equity participation, only this time 1/3 equity, 2/3 debt.
More equity.
So more equity, more equity risk and upside potential for investors. And the other option was an all equity participation. And we allowed for pension funds to essentially choose between the two. Some of them opted for the debt equity, some of them opted for the all equity. And then we open up to other investors.
Private investors.
We broaden our investor universe to also include an endowment fund, and some private individuals through a structure designed by one of the Danish banks and some of their high net worth individual customers. So now we have 3 different investor segments: pension funds, endowment funds, and private money from private savers, essentially.
Very interesting. Now, I understand where the money comes from, and I think you mentioned also where the money goes to. Did I understand it correctly? 20% of the capital raised goes into venture and 80% into private equity.
That was for the first fund entity that we set up. The second one is 1/3 venture, 2/3 small cap, mid cap buyout.
So you're becoming more, so to say, risk happy, or how do you call that?
Most of that risk aversion I mentioned before was designated toward the venture space, at least more so than the private equity or the buyout space. But building on the encouraging results that we have delivered so far, we were able to design a different breakdown of the expected portfolio. We're still investing out of the second fund-of-fund model. We're halfway through, and in that model, we allowed for 1/3 venture, 2/3 private equity.
Okay. Now, one final question before we get into the results and the effects, also on the macroeconomic level for Denmark. Who is the management team? Which people did you hire? Did you scout and screen the best investment managers worldwide, or did you, so to say, I don't know, offer the jobs to some bureaucrats from the public sector that were already, I mean, in positive meaning bureaucrats, public servants, let's call them that way, that took that jobs?
At the fund-of-fund level, where Vækstfonden acted and is acting as the manager.
Yes.
We built on our existing platform, so the team that we had already in place, people who had been investing exclusively on behalf of Vækstfonden for many years prior to that. And then it essentially expanded our mandate to be both balance sheet investing for Vækstfonden and investing through this fund-of-fund mandate with the pension funds. And then we've expanded that team since then, recruiting from the institutional investor space and
venture capital funds,
corporate finance space. Yeah. No, not really from VC funds or private equity funds, because that's a different animal, essentially. Selecting and working with portfolio companies is different from selecting and working with
That's a good point.
VC funds and private equity funds. But you need to have that understanding of what constitutes a great VC manager, what constitutes a great PE manager, when you act as a fund-of-fund manager. But the people that we have in place, the people that make up our fund-of-fund team, they all come from the private sector.
Excellent. Now let's look at the effects and results, and I would be interested in twofold, so to say, view. First of all, what happened with the pension funds? Were they happy with their investments on the equity side, on the debt side? And the second, the macroeconomical impact for Denmark. Did you see, let's say, more young companies coming out, more innovation being produced, new unicorns being built out of this initiative?
That's a great question, because it frames the two main objectives behind setting up this whole structure. One was to deliver attractive results on the investments themselves. The other one, and the one behind the Prime Minister's desire to have this created, was show some strong impact on economic development, job creation, exports, and tax payments throughout the Danish economy. And I'm excited to be able to say at this stage, where we're through the investment period and are starting to see money being returned from investors, that we've delivered in both dimensions. On the financial results, we're currently running at a 17.4 net IRR.
Explain that, the KPI.
Net IRR means what's a net financial result after we've paid all the costs involved in managing the fund. So essentially, the result to be returned to investors in the fund. Now,
even though it's still going, and some investments are coming back in the future.
Some of these returns are realized investments. So we have seen money coming back. Slightly more than half is still unrealized assets. So there's still value to be created out there in the portfolio, which in terms of the number of companies that this whole structure has enabled funding for. We come pretty close to 200 portfolio companies, 70% of which are Danish companies. So it's a very strong, very widespread impact on the Danish economy. In terms of job creation, latest count was 2,000 jobs created throughout the portfolio.
Amazing. Amazing. And the returns on the pension fund investors are given both on the equity side and on the debt side, the loan side?
On the equity side, they participate along with Vækstfonden on the equity return. If we manage to maintain a net IRR of 70% or in that ballpark, then that is what they will receive on the equity investment, so the 25% in that structure. On the debt side, Vækstfonden essentially has done a leveraged investment in that we have debt financed our equity participation. So Vækstfonden earns the 17% or whatever the ultimate IRR will be on the equity participation, and what we have paid for the loans that we have accumulated to finance our equity participation is the 10-year treasury bond plus 150 basis points. And the reason for the 150 basis points is that this is an illiquid investment.
For 10 years, illiquid.
It's illiquid for 10 plus years, essentially, because we won't be winding down the fund for until long into the next decade.
So 1.5% are on top as a premium for this illiquidity.
Exactly.
Okay, very, very interesting. We didn't mention the whole volume of the fund. What was the initial sum that you raised?
Initially, we raised 550 million euros. And by the time that we had built our portfolio, the 16 different underlying funds, we realized that we weren't going to deploy all of it, so we returned some of that to the investors.
Because you found that there was enough capital raised to, so to say, fulfill the goals, and the extra sum was not necessary.
Yeah, that's right. So we returned slightly more than 15% of that.
Okay. And so the second fund, how strong was the volume there?
That we scaled down the fund. In terms of amount raised, so close to 400 million or 350 million euros. No, I'm sorry, 400 million euros. And then we still want to deploy capital across VC and private equity, and a total portfolio of funds underlying around the same number as the first one, so 13, 15 funds, somewhere in there.
I'll try to sum it up. Please correct me if I'm wrong. Fund of Funds had 400 or 500 million euros at the end of the day. The pension funds that invested got excellent return on investment. The economy got new companies, new innovation, new jobs. I mean, somehow it seems too good to be truth. Was it such a success story the way I understood it, or is there a trick somewhere that I don't get?
No, you captured it beautifully in your summarization of our experience, and we're happy to now hear from our investors, the pension funds, that we have surprised them in a very positive way. When they made their investment originally, they did not expect equity returns in this range. It was exactly because of those promising results that we were able to raise the second model that we're investing out of now, and who knows what will happen in the future.
Rolf, all the best for the future, and thank you for taking time to explain this model. I didn't have these deep insights, and it sounds very, very exciting, and I think we'll be looking at it on all, so to say, levels in Austria into it as well. Thank you for being with us.
it was a pleasure, and I really hope that you end up signing something like this in Austria, and we're happy to help.
Great, thank you. And thank you for listening. We're going to be talking maybe in 10-15 minutes with Rolf Kjærgaard, the president of AVCO as well. Thank you, Rolf, and we'll see you later. Excellent.